Ever feel like the world of finance speaks a secret language? Full of baffling terms and these complex concepts. It can certainly feel like that sometimes.
Oh, absolutely.
Well, today we're going to try and cut through some of that jargon. We're unlocking some of its most powerful secrets.
It's true. And, this isn't just theory for the finance pros. Understanding how risk and return really work, and maybe more importantly, how to manage them. That can literally change your financial life.
Yeah,
Whether you're, say, saving for a home, investing for retirement, maybe running a business.
absolutely. Welcome to the deep dive. Our mission today is, well, a pretty comprehensive exploration of financial risk management.
Hmm.
And like you just heard, this isn't just about huge corporations or Wall Street. These are fundamental concepts.
Hmm.
They apply to basically anyone dealing with money, investments, or, business.
Right.
We've pulled together a stack of sources that give us a really clear, comprehensive look at various financial risks and, crucially, the proven strategies to manage them. Okay, let's unpack this. Let's start with the absolute bedrock of finance, right? The relationship between risk and return.
Okay.
At its simplest, risk is, well, the chance of financial loss. More formally, maybe think of it as how much the potential returns on an investment might vary from what you actually expect.
Right. The variability.
Exactly. And return, that's just the total gain or loss you get from holding an asset over time. Now, the core principle here, the one you always hear, is that typically greater risk leads to the potential for greater returns.
Typically, yes.
Why is that? Well, usually sellers of financial securities need to compensate buyers for taking on more risk. They do that by offering a higher potential payoff. It's kind of like if you're willing to take a bigger leap, there might be a bigger reward waiting.
That's spot on. And how much bigger reward someone needs for that bigger leap, well, that's not the same for everyone. It really depends entirely on their risk preference.
Okay.
Different individuals, different managers, they have distinct attitudes toward risk. We usually categorize these into three basic behaviors. First, there's risk indifferent behavior.
Right.
For someone like this, an increase in risk doesn't really change the rate of return they require. They're kind of neutral.
Okay.
Then we have risk-averse behavior. Now, this is where an increase in risk definitely requires an increase in the rate of return. These people need more compensation for taking on greater risk.
That sounds like most people, maybe.
It is. And it's important to note most managers in the business world, and frankly, most people making careful financial decisions, they tend to be risk-averse.
Makes sense.
Finally, there's risk-seeking behavior. This is the opposite. An increase in risk actually results in a decrease in the required rate of return.
Really?
Yeah. These are the folks who are okay settling for lower expected returns as the risk level goes up, maybe because they just enjoy the thrill of the risk itself.
So, what does all this mean for you, the listener? Are you the type to meticulously plan every single detail of a trip? Check everything twice? Or are you more inclined to just, book a flight and see where you end up? Understanding your own personal risk preference is just incredibly crucial for all your financial decisions. It helps you pick the right investments, truly grasp what loans actually cost, and make choices that align with what makes you comfortable or, uncomfortable in your financial life.
The key insight here really is that understanding your own risk profile, that's the absolute first step toward making informed financial decisions.
Right.
If you're highly risk-averse, you'll naturally gravitate towards investments that offer more predictability, maybe lower potential returns. If you're a bit more comfortable with risk, you might explore opportunities with higher upside. But there's also higher downside. It's about self-awareness, really.
Okay, now here's where it gets really interesting. Because risk, it isn't just one big, vague thing. It's actually a whole family of distinct challenges,
Yeah.
right? Each with its own nuances and, importantly, ways to manage it.
Exactly.
When we talk financial risk, we're looking at specific exposures like interest rate risk, market risk, default risk, credit risk, liquidity risk, and price risk. That's quite a list.
It is. Let's break those down a bit. First, interest rate risk, sometimes called yield risk.
Okay.
This is the exposure an owner of, say, a bond has to value fluctuations just because general interest rates in the economy change. Imagine you own a bond paying a fixed 3% interest.
Mm-hmm.
If new bonds are suddenly being issued paying 5% because overall rates have gone up, well, your 3% bond isn't quite as attractive anymore, is it? Its market value will likely fall.
Got it.
Next up, market risk. This is also known as systematic or non-diversifiable risk.
Systematic, okay.
It's the exposure a security or even a whole company has to value fluctuations simply from operating within the broader economy. These are the big picture factors: war, inflation, major political shifts, economic downturns.
Stuff you can't control.
Precisely. And the crucial part here is that it's non-diversifiable. You can't escape it just by having a diverse portfolio, because these events affect pretty much everything in the market.
Right.
Now, in contrast to that, there's unsystematic risk. This is also called firm-specific or diversifiable risk.
Diversifiable. Okay, that sounds better.
It is, in a way. This is the part of, or an industry's risk that's associated with random, specific causes unique to that entity. Think things like a company strike, maybe a product recall, a big lawsuit against just one firm, or losing a major customer.
Right. Very specific thing.
Exactly. Yeah. The good news about unsystematic risk is that it can be eliminated, or at least significantly reduced, through diversification.
This is such a critical distinction, and I heard a little mnemonic to remember the difference between these two big categories. It's DUNS. Diversifiable goes with unsystematic, which is the non-market or firm-specific stuff, and non-diversifiable goes with systematic,
The market risk.
the market risk. DUNS. It's a great little trick to keep those straight.
That's helpful. Think of it like this. Diversifiable, unsystematic risks are kind of like issues specific to your car.
Mm-hmm.
Maybe a flat tire, an engine problem.
Okay.
You can manage these, right? Have a spare, get regular maintenance, maybe you have another way to get around.
Mm-hmm.
Non-diversifiable, systematic risks are like a citywide traffic jam or a sudden huge spike in gas prices. These affect everyone, no matter how well you maintain your car.
Right. You can't avoid those just by having different cars.
Exactly. They're part of the system.
Okay.
Continuing on, we have credit risk. This one mainly affects borrowers.
Borrowers. Okay.
It's a company's inability to secure financing or get favorable credit terms, maybe because their credit rating has gone down. When your credit rating drops, lenders demand higher interest rates, they might want more collateral, and the loan terms just generally become much less favorable.
Not good.
No. Closely related is default risk, but this one mainly affects the lenders.
The other side of the coin.
Exactly. It's simply the possibility that debtors won't repay the principal or interest due on their loans on time, or at all.
Right.
Then there's liquidity risk. This impacts both lenders and investors. This is the risk that you want to sell a security or an asset, but you can't do it quickly enough. Or maybe you have to accept a significantly lower price just to make the sale happen fast.
Like trying to sell something really obscure versus a popular stock.
Precisely. Think about selling a unique handmade antique versus selling, say, Apple stock. The antique has much higher liquidity risk. And finally, price risk. This represents the exposure investors have to a decline in the market value of their individual securities, or even their entire portfolios. It's closely related to that diversifiable, unsystematic risk, and it can become a much bigger worry during periods of high market volatility.
Wow. Okay. So knowing these distinctions really helps you understand exactly where potential dangers might lie in your investments, or maybe in a business you own, or even just in your personal financial planning.
Right.
It's about being able to identify the specific challenge you're facing before you try to tackle it. So we've identified what risk is, how we might feel about it, but how do we actually measure the return we're getting, or maybe the true cost of borrowing? It's not always as simple as it sounds, is it?
No, it's not.
No.
Because there are several ways interest rates, which are, a core part of measuring return, are calculated and presented. Let's dig into some of these to really understand what's happening behind the numbers.
Good idea.
Okay, let's start with the stated interest rate, also called the nominal interest rate.
Okay, nominal.
This is the simple rate of interest quoted before any adjustments for compounding or other fees. So if a loan agreement says 10% interest per year, that's your stated rate, just what's written on the paper.
Simple enough.
Then we have the effective interest rate. Now, this is the actual finance charge you incur after you account for any upfront fees that reduce the net amount of money you actually get to use.
Ah, the fees.
Exactly. Imagine you take out a $10,000 loan at a stated 10% interest, but maybe the bank charges you a $75 origination fee and a $50 administrative charge, and they take those right off the top.
So you don't get the full $10,000.
Right. You'll pay $1,000 in interest over the year based on the $10,000. But you only receive $9,875 in actual usable funds. So your effective interest rate is actually higher than 10%.
Because you're paying the same interest on less money.
Exactly. You're paying $1,000 interest on essentially $9,875 received. It works out to about 10.13%.
Right. That's important.
Very. Then there's the annual percentage rate, or APR. This is a non-compounded version of the effective interest rate. It's the rate required for disclosure by federal regulations. You see it a lot.
Right, on credit card offers and things.
Yes. It takes your effective periodic rate and multiplies it by the number of periods in a year. So if you have a loan with an 8% stated rate, but it's paid semi-annually, and there's some fees involved, your effective rate for each 6-month period might be, say, 4.5%.
Okay.
Multiply that by 2 periods in a year, and your APR is 8.10%.
Slightly higher than the stated 8%.
Correct. Now, related to that is the effective annual percentage rate, or effective APR. This is the stated interest rate adjusted specifically for the number of compounding periods per year. This one really accounts for the power of interest on interest.
Compounding. That's where it gets interesting.
It is. So an 8% stated rate that's compounded semi-annually actually results in an effective APR of about 8.16%.
Yeah.
It's slightly higher than the simple 8% or even the basic APR because your money is earning interest on the accumulated interest more frequently throughout the year.
Okay.
We should also mention simple interest. This is interest paid only on the original principal amount. It completely ignores any compounding.
Yeah.
Very straightforward calculation.
Oh, basic math.
Pretty much. So on a $10,000 loan at 8% simple interest for 2 years, you just pay $800 each year. Total interest, $1,600.
Easy.
And finally, compound interest. This is where the interest earnings or expense are based on the original principal plus any unpaid interest that is already accumulated. This is where your interest starts earning its own interest.
The snowball effect.
Exactly. It leads to a significantly higher total amount over time compared to simple interest. That same $10,000 loan at 8% for 2 years, but compounded annually, would result in a maturity value of $11,664.
So $64 more than simple interest just from compounding once a year?
Correct. That extra bit is the magic, or sometimes the pain, of compounding.
So why do all these different ways of calculating interest matter so much to you, the listener? Well, because they impact the actual cost of your loans or the actual earnings on your savings.
Absolutely.
The key insight here is, while a loan might state one interest rate, you always need to dig deeper for the effective rate that's the real cost, because it includes all those often hidden fees and the power of compounding. It's the difference between thinking you're paying X and actually paying Y. So expert, when someone is comparing 2 different loan offers, which rate should they always focus on to get the truest picture?
You absolutely hit it. For any loan, always look for the effective annual percentage rate, effective APR. That's the most comprehensive measure.
Okay.
It takes into account not just the stated interest, but also the fees and the impact of compounding. It truly tells you your real cost of borrowing or your real return on an investment. That's the number for an apples-to-apples comparison.
Got it. Effective APR.
Beyond these calculation methods, investors and creditors also think about something called the required rate of return.
Okay, what's that?
This is basically the minimum rate of return an investor needs to receive to compensate them for all the various risks they're taking by making that investment. It's essentially built up from a base risk-free rate plus several specific risk premiums.
Like layers of compensation for different worries.
Exactly. First, there's the maturity risk premium, MRP. This compensates investors for being exposed to interest rate risk over a longer time. It generally increases the longer the term of the investment.
Makes sense. Longer time, more uncertainty.
Right. Second, the purchasing power risk, or inflation premium, IP. This compensates for the risk that general price levels will change inflation and erode the value of your asset or the purchasing power of the dollars you get back.
Crucial one these days.
Very. Third, the liquidity risk premium, LP. This is extra compensation demanded for the risk that an investment security can't be sold quickly without accepting a significant price cut. Remember our antique example.
Right. Harder to sell, you want more return for holding it.
Exactly. And fourth, the default risk premium, DRP. This compensates for the risk that the issuer, the borrower, will simply fail to pay the interest or the principal on time.
The risk they just won't pay you back.
Correct.
So if a bank is looking to invest in, say, a corporate bond, and they decide they need an 8% required rate of return, it's not just some random number they picked.
No, not.
They're breaking it down. They might start with maybe a 3% real rate of return they want just for using their money. Then they add, say, a 2% inflation premium to cover the expected erosion of purchasing power. That gets them to a 5% nominal rate. Then they tack on maybe another 3% combined for all those other specific risks, the chance the bond issuer defaults, DRP, the risk they can't sell it easily if needed, LP, and the risk associated with its maturity date, MRP.
That's the process.
So that 8% is truly the minimum they feel they need to earn to be compensated for all those different layers of risk they're taking on. That's fascinating. It really shows how deliberate this process is, or at least should be.
It should be, yes. It quantifies the trade-off.
Okay, now that we've truly mapped out the landscape of financial risk, identified all these different types, how do we actually do something about it? How do we protect ourselves or our businesses?
Right. It's not just about identifying risks.
It's about proactively implementing strategies to mitigate and control their impact. Where do we start?
Well, the first, and you could argue the most fundamental strategy, is diversification.
Ah, the classic. Don't put all your eggs in one basket.
Exactly that. This technique is all about building a portfolio of investments with different and ideally offsetting risks. The main goal of diversification is to eliminate that unsystematic or diversifiable risk we talked about earlier.
The company-specific stuff.
Right. If one part of your portfolio experiences a downturn, say a specific company you invested in faces a lawsuit, another part might be performing well, balancing things out. However, and this is crucial to remember,
Okay.
diversification cannot mitigate non-diversifiable or systematic risk.
The market risk. DUNS again. DU can be diversified, NS cannot.
Precisely. That market risk we talked about tied to war, inflation, big economic events still affects a diversified portfolio because it's inherent to the whole economy. So a truly diversified investor should primarily be concerned with managing that broad systematic risk because they've theoretically minimized most of the other stuff.
Okay, so diversification is our primary tool for company-specific risks. But what about those broader risks? Let's look at specific strategies for some of the specific types of financial risk we identified.
Good idea. To mitigate interest rate risk, for example, an investor could choose floating rate debt securities.
How does that help?
Their value isn't as sensitive to general interest rate changes because the interest payments they make actually adjust along with market rates. Another approach is using derivative like forward rate agreements, FRAs, or interest rate swaps.
Swaps sound complicated.
They can be, but the idea might be you agree to pay a fixed rate but receive a floating rate from someone else, effectively canceling out your exposure to floating rates if you have floating rate debt, for instance.
Okay. What about market risk? You said that's harder.
It is trickier, yes. Since it's inherent in the marketplace and affects the whole economy, you can't just diversify it away. Strategies here often involve using derivatives that are actually designed to gain value when the market declines.
Betting against the market, in a way.
Essentially, yes, to offset potential losses in your main investments. Short selling is another strategy. That's where you sell an investment you don't actually own yet, hoping to buy it back later at a lower price, profiting from a market downturn.
Risky, though.
It can be very risky, yes. Needs careful management. Consider the CFO of, say, Dillon Bank. She's concerned an upcoming economic report might trigger a stock market decline, hurting the bank's investment portfolios.
Okay.
To protect against this, she might open several short positions in S&P 500 index funds. If the market does decline, the bank profits from these short positions, which helps to offset the losses in their traditional long investments.
Ah, so it's a hedge, a way to protect the downside.
Exactly. It's a way to hedge your bets, so to speak. Now, unsystematic risk, as we discussed, is primarily tackled through diversification.
Right. Spreading things out.
If you have a broad portfolio across various companies and industries, a negative event hitting just one company or sector will have a much smaller impact on your overall portfolio's value.
Makes sense. What about credit risk? The borrower's risk.
For credit risk, the strategy often revolves around improving your creditworthiness. Companies are evaluated on things like their economic outlook, their cash flow stability, leverage levels, management strength. Higher credit ratings lead to more favorable borrowing terms, lower interest rates.
So being a better borrower helps you manage that risk.
Absolutely. Now, for default risk, which is the lender's risk,
Right. The risk of not getting paid back.
a lender has a couple of main options. They can choose to only lend to borrowers with a very low risk of defaulting very strict standards. Or they can adjust the interest rates they charge to better reflect the risk of each borrower.
Meaning riskier borrowers pay higher interest rates.
Correct. To compensate the lender for that increased risk of default.
So let's take Miller Inc. If they want to reduce default risk from their customer loans, they could either tighten their lending standards way up, only approving customers with excellent credit.
Option 1.
Or they could keep lending to a broader range of customers, but just charge higher interest rates to those they deem riskier.
Option 2. Exactly. Two different paths to manage the same underlying risk.
Okay. What about liquidity risk? Getting stuck with something you can't sell easily.
When it comes to liquidity risk, which is naturally higher for investments that don't trade often or aren't standardized,
Like that antique again?
right? It's best mitigated by allocating more of your capital to investments that trade on active, deep markets. Think publicly traded stocks, highly rated corporate bonds, futures contracts, options, things you can generally sell quickly without a huge price drop compared to, say, niche real estate or private equity stakes.
Got it. Stick to things others are also buying and selling actively.
Generally, yes, if liquidity is a primary concern. And finally, price risk. The risk your investment value just drops.
Yeah, the one most investors feel directly.
It can be minimized through diversification, as we said, but also through strategies like short selling or using derivatives like put options. A put option gives you the right to sell an asset in a predetermined price, which can protect you from a market decline below that price.
Lots of tools in the toolbox then.
There really are. It's about choosing the right tool for the specific risk you're facing.
Okay, whew. If you thought domestic finance was complex, just imagine adding an other currency into the mix.
Haha, yes, it adds another layer.
When you're dealing internationally, the values of assets, liabilities, transactions, they aren't just in one currency. They're relative to other currencies too. This is where currency exchange rate risk comes crashing in because that relationship between currencies can be incredibly volatile.
It really can. And there are several factors that influence exchange rates. We can generally group them into trade-related and financial factors.
Okay, let's start with trade.
For trade-related factors, first consider relative inflation rates. If a country's domestic inflation is running much higher than foreign inflation,
So prices are rising faster at home.
right, people holding that domestic currency will often try to buy foreign currency to protect their purchasing power. This increased demand for the foreign currency makes it more valuable relative to the high inflation currency.
So if the US dollar is stable, but say Mexican peso inflation is high, Mexicans might buy US dollars.
Exactly, driving up the dollar's value against the peso.
Okay. What else on the trade side?
Another factor is relative income levels. As income increases in one country compared to another, there tends to be more demand for foreign goods and services, and thus foreign currencies, in the country where income is rising faster.
Like if US incomes jump, Americans travel more, buy more imports.
Precisely. They might vacation more in Mexico, buy more pesos. This increased demand for pesos using dollars causes the dollar's value to fall relative to the peso in that scenario.
Interesting.
And then, of course, there are government controls. Things like trade barriers, tariffs, quotas, or direct exchange controls can artificially suppress the natural supply and demand forces.
Interfering with the market rate.
Right. They can prevent a currency from moving to where the market would otherwise take it.
Okay, those are trade factors. What about financial factors?
Moving to financial factors, a big one is relative interest rates and capital flows. Higher interest rates in a country tend to attract foreign investment. Why? Because investors can earn more there.
Money follows yield.
Exactly. This increases demand for that country's currency. So if returns on investments in, say, Brazil suddenly shoot up while U.S. returns stay low, U.S. investors will seek Brazilian reals to invest there. This increased demand for reals makes the real command more U.S. dollars.
So capital flows chasing higher returns directly move exchange rates.
Absolutely. All these factors, inflation, income, government actions, interest rates, they all interact. It's a dynamic dance of supply and demand constantly pushing and pulling currency values.
Wow. Okay, so when we talk about the risk from these currency fluctuations, our sources break it down into three important types of exposure. What are they?
Right. First, there's transaction exposure.
Transaction.
Okay. This is the potential economic gain or loss a company could face when individual transactions actually settle, purely because the exchange rate changed between the time the deal was agreed upon and when the cash actually changes hands.
So the risk on a specific deal that's already in progress?
Exactly. To measure this, you'd project your expected foreign currency inflows and outflows, and then estimate how much that foreign currency's value might realistically fluctuate before settlement.
Got an example.
Sure. Say a software company in Seattle expects a net inflow of 2 million Canadian dollars from a Canadian client in 3 months. The current rate is, let's say, 75 US cents per Canadian dollar. So that's $1.5 million US expected.
Okay.
But what if the rate could fluctuate between 70 cents and 80 cents over those 3 months? Their actual US dollar receipt could range anywhere from $1.4 million to $1.6 million. That $200,000 range, that's their transaction exposure on that specific deal.
Okay, that's clear. What's the next type?
Next is economic exposure. This is broader. It's the potential for the present value of an organization's entire stream of future cash flows to increase or decrease because of long-term exchange rate changes.
So not just one deal, but the whole business outlook.
Right. It's often defined by how domestic currency appreciation or depreciation affects a company's long-term earnings and cash flows structurally.
How does that work?
Well, when a domestic currency appreciates gets stronger, your exports become more expensive for foreign buyers. So your revenue inflows from foreign currency payments tend to go down. And imports become cheaper, so your expense outflows if you pay foreign vendors might actually increase.
Okay, strong currency hurts exports, helps imports.
Generally, yes. And when a domestic currency depreciates gets weaker, the opposite happens. Your exports become cheaper for foreign buyers, potentially boosting revenue inflows. But imports become more expensive, potentially increasing expense outflows. Economic exposure really depends on your company's overall net inflow or outflow of foreign currency and how your long-term cash flows are set up.
Got it. And the third type.
Finally, we have translation exposure. This is purely an accounting-related risk.
Accounting.
Yes, it's the risk that the assets, liabilities, equity, or income of a consolidated organization that includes foreign subsidiaries will change on paper simply as a result of converting their foreign currency financial statements back into the parent company's domestic currency for reporting purposes.
Just because the exchange rate moved when you do the math for the financial report?
Exactly. It's influenced by how much foreign involvement a company has, how many subsidiaries, how big they are, and how stable those foreign currencies are.
So a company that just exports versus one with factories all over the world.
Right. A company like, say, Domestic International Inc., which only exports goods made at home, has much less translation exposure than Global International Inc., which might have a dozen foreign subsidiaries making up 65% of its total reported revenues. Global International faces significant translation exposure because so much of its financial picture is initially measured in various foreign currencies before being translated back to dollars for the consolidated report.
So it's not just about what you're buying, selling today, transaction risk, or even the long-term cash flow impact economic risk, but also how your entire global presence, your whole balance sheet and income statement gets valued on paper.
Precisely. Those three types of exposure transaction, economic, and translation really paint the full picture of currency risk for any company operating internationally.
Okay, this is where it gets really tactical then. Now that we understand these currency risks, how do companies actually hedge against them? What does hedging even mean here?
Good question. Hedging is basically a technique used to mitigate or lessen future value fluctuations. You do this by acquiring some kind of financial instrument or taking an action that is expected to behave in the opposite manner from the item you're trying to protect, the thing being hedged.
So if one goes down, the other goes up, canceling out the loss.
That's the goal. It's about reducing the uncertainty of a future financial outcome, locking something in, or at least limiting the potential damage.
Okay, so for that transaction exposure, the risk on specific deals, what are the tools?
Well, companies can use several hedging instruments. First, they might practice selective hedging, where they decide to hedge only certain individual transactions they deem particularly risky. Or they might look at their overall net exposure across their entire company, netting out payables and receivables in the same currency, before deciding what, if anything, needs to be hedged.
So maybe offsetting inflows and outflows cancel each other out naturally sometimes.
Exactly. Sometimes even simple adjusting invoice policies can help, like strategically timing when you pay for imports to coincide with when you collect cash from exports in the same currency.
Clever. But what about actual financial products?
Right. A common one is a futures hedge. This is a standardized contract you buy or sell on an exchange. It locks in a price to buy or sell a specific amount of a currency on a specific future date. Futures are typically for smaller, more standardized transaction amounts.
How would that work for, say, paying a foreign supplier?
Okay, if you have an accounts payable in a foreign currency, maybe euros, and you're worried your domestic currency, the dollar, will weaken before payment is due, meaning you need more dollars to buy the same amount of euros.
Right, the payment gets more expensive in dollars.
You could enter a futures contract today to buy the euros you'll need at a specific dollar price when the payment is due. This locks in your dollar cost right now.
And for getting paid, accounts receivable.
The opposite logic. If you have accounts receivable in a foreign currency, say Japanese yen, and you fear your domestic currency, the dollar will strengthen, meaning the yen you receive will convert into fewer dollars.
Your revenue shrinks in dollar terms.
You could enter a futures contract today to sell the yen you expect to receive at a specific dollar price. This locks in the dollar value of that receivable now.
Okay, futures are standardized. What
A
else?
forward hedge is very similar conceptually to a futures hedge locking in a future rate, but forwards are typically larger, customized contracts negotiated directly between a business and a commercial bank.
More tail.
Yes, often tailored to the specific amount and date the company needs, rather than the standardized exchange contracts. But the core idea, locking in a future exchange rate for a payable or receivable, is exactly the same.
Got it. Futures and forwards lock the rate. What else?
Then there's the money market hedge. This is a bit different. It involves using the money market borrowing and lending to effectively lock in an exchange rate today for a future transaction.
How does that work? Let's say for a payable.
Okay, imagine a U.S. company, Duffy's Discount Piñatas, owes 1 million Mexican pesos in 90 days. They're worried the peso will strengthen against the dollar. Instead of using a forward or future, they could figure out how many pesos they'd need to invest today in Mexico at Mexican interest rates so that it goes to exactly 1 million pesos in 90 days.
Okay, like the present value.
Right. Let's say that's 961,538 pesos. They then use U.S. dollars today to buy those 961,538 pesos at the current spot exchange rate, say 0.8 peso, costing $76,923. They deposit those pesos in a Mexican bank account earning interest. In 90 days, that deposit matures to exactly 1 million pesos, which they use to pay their supplier.
Ah, so they locked in the cost in dollars, $76,923 today, by using the spot rate and interest rate.
Exactly. They've eliminated the exchange rate risk over the next 90 days. Now, they might need to borrow those initial dollars domestically if they don't have spare cash, which adds an interest cost, but the exchange rate risk is gone.
And for receivables.
Similar logic, but reversed.
Yeah.
Duffy's expects to receive 1 million pesos in 90 days. They could borrow the present value of that amount in pesos today, immediately convert those borrowed pesos into dollars at the current spot rate, and then use the incoming 1 million peso receivable in 90 days to pay off the peso loan. They get their dollars today, locked in.
Clever. Using borrowing and lending to fix the rate. What about options?
Currency option hedges offer more flexibility. An option gives the business the right, but crucially not the obligation, to buy or sell currency at a specific price, the strike price, on or before a certain date.
Right, not obligation. That's key.
It is. You pay a price for this option, called a premium, which is like buying insurance. It's a sunk cost. But it gives you choices.
So how would that work for a payable?
For payables, you'd buy a call option. This gives you the right to buy the foreign currency at the strike price. Let's say Gertie International owes 1 million pesos and fears the peso will strengthen significantly from the current $8. They buy a call option with a strike price of 8 cents, maybe paying a premium of half a cent per peso, $5,000 total.
Okay.
Now, if the spot rate in the market goes up to, say, 0.10 when payment is due, they exercise their option. They buy the pesos at $0.08, saving Duzorda at 2 cents per peso compared to the market. That's a $20,000 saving minus the $5,000 premium for a net gain of $15,000 compared to not hedging.
And if the peso weakens, goes to 7 summers.
Then they just let the option expire worthless. They buy the pesos in the spot market at the cheaper $0.07 rate. They're out the $5,000 premium, but they benefited from the favorable rate movement. The option protected them from the upside risk, peso strengthening, but let them benefit from the downside.
Okay, so it provides protection but preserves potential upside or downside benefit.
Yeah.
And for receivables.
For receivables, you'd buy a put option. This gives you the right to sell the foreign currency at a strike price. Same company, Gertie, is owed 1 million pesos, but now they fear the peso will weaken below 0.8 cents. They buy a put option with an 0.8 cent strike price, again paying the $5,000 premium.
Sure.
If the spot rate drops to $0.06 when they receive the pesos, they exercise the put option. They sell their pesos at 0.8 cents, locking in that rate. They preserve 0.2 cents per peso, or $20,000 in value, less the $5,000 premium, for a net benefit of $15,000 compared to the unhedged market rate.
And if the peso strengthens to 99 cents?
They let the put option expire. They sell their pesos at the better market rate of 0.9 cents. They lost the premium, but they captured the gain from the favorable rate movement. The put protected them from the downside risk, peso weakening.
That makes perfect sense. Options provide insurance against unfavorable moves while letting you benefit from favorable ones, but you have to pay that premium up front.
Exactly. It's a trade-off between the certainty of forwards futures and the flexible protection of options, which comes at a cost.
So with all these different tools, futures, forwards, money markets, options, how do companies handle transactions that are much further out in the future, maybe years down the line, not just 90 days?
Good question. For long-term transactions, the standard short-term tools might not be available or might be too expensive. Companies can sometimes use long-term forward contracts, if available, which work the same way but cover longer periods. Another powerful option, especially for recurring exposures, is currency swaps. This is where two firms, often in different countries with complementary currency needs, agree to exchange streams of currency payments over several years at a predetermined exchange rate.
How would that work?
Imagine a U.S. firm needs a steady supply of Polish zlotys to pay for raw materials over the next 5 years. A Polish firm, meanwhile, needs U.S. dollars to service debt. They could agree to swap, say, 500,000 U.S. for 1.5 million zlotys, a rate of 3.0 zloty USD, each year for 5 years, and then swap the principal back at the end.
So they both lock in the rate for their ongoing needs.
Precisely. It hedges their long-term recurring currency exposure. Now, there's still risk. If the zloty depreciates significantly, say to 3.25 zloty USD, the U.S. firm is still paying the equivalent of $500,000, but receiving zlotys that are now only worth about $461,538 in the market. They incur an opportunity loss on the swap in that year.
So the swap fixes the rate, but you can still lose out if the market moves dramatically against the rate you locked in.
Correct. Another related tool is a parallel loan, where firms essentially swap loans in their domestic currencies to get access to foreign currency, agreeing to re-exchange later.
Okay. Are there any other, maybe less common techniques?
Yes, a few alternative hedging techniques exist. One is leading and lagging. This usually happens between subsidiaries or a subsidiary and its parent company. You might bill a subsidiary earlier than usual, leading, if you expect their currency to weaken, or delay payment, lagging, if you expect your own currency to weaken. It's about timing payments and collections strategically based on expected rate movement.
It's internal maneuvering.
Right. Then there's cross-hedging. This involves hedging the risk of one currency using a derivative based on a different but closely correlated currency. You might do this if a direct hedge for the currency you're exposed to isn't available or is very illiquid.
Using a proxy.
Kind of, yes. And perhaps the simplest long-term hedge, though less precise, is currency diversification. Simply holding assets, conducting business, or having cash flows in various different foreign currencies means that a significant decline in any one currency is less likely to heavily impact the overall value or performance of the firm.
Spreading the currency risk out, just like diversifying investments.
Exactly the same principle applied to currencies.
Okay, finally, let's look at the bigger picture impacts again, beyond those individual transactions. How do companies deal with that broader economic exposure and translation exposure? These seem like they might require different kinds of solutions.
They often do, yes. They often require more fundamental organization-wide solutions rather than just hedging specific deals with financial instruments.
So how do you assess economic exposure first?
You assess economic exposure by looking at how the entire business's long-term cash flows are fundamentally affected by sustained exchange rate fluctuations. It really comes down to analyzing where your revenues come from which currencies and where your expenses are incurred which currencies.
Give us an example.
Okay, think about Pete's Primo Piñatas. They manufacture their piñatas in Mexico, so their labor and material costs are mostly in Mexican pesos. But they export almost all their products to the U.S., so their revenues come in as U.S. dollars.
Okay, expenses in pesos, revenue in dollars.
Right. Now, what happens if the peso suddenly strengthens significantly against the dollar over a long period? Pete's USD revenues, when converted back to pesos to pay his local costs, will buy fewer pesos. His profit margins get squeezed, potentially leading to ongoing economic losses, even if his sales volume in the U.S. stays the same.
That's a classic example of how currency fluctuations can really squeeze a business, even if it seems perfectly fine on paper in its local currency. What kind of solutions are there for that kind of systemic economic risk? It's not just about one payment.
It's not. The techniques for economic exposure mitigation usually involve restructuring the business plan or operations itself. It's more strategic.
Like what?
For example, if Pete fears a long-term strengthening peso, like in our example, he might explore shifting some production to the U.S. to have dollar-based costs match his dollar revenues. Or if a company fears a depreciating foreign currency, where they have a subsidiary selling locally, they might choose to reduce their reliance on sales from that subsidiary.
So, changing where you make things or where you sell things.
Potentially, yes. Or changing sourcing. If you anticipate a currency depreciating in a country where you source materials, you might increase your reliance on suppliers in that country to take advantage of those cheaper costs when translated back to your home currency.
So fundamental business changes.
Often, yes. And it's important to note, restructuring for economic exposure is generally much more difficult, much slower, and often more costly than simply using standard hedging techniques for transaction exposure.
Because you're changing the core business model, not just putting on a financial hedge.
Exactly. Economic exposures are widely considered more challenging to manage effectively because they strike right at the core of how and where a business operates.
Wow. What a journey we've been on. We've covered so much ground here. From the foundational trade-offs between risk and return,
Mm-hmm.
to decoding all those different faces of financial risk, diving deep into how returns and interest rates are actually measured.
All those calculations.
Right. And finally, exploring this huge array of strategic hedging instruments and techniques, from basic diversification right through to navigating these complex global currency markets. It might seem daunting, I know.
It can feel that way.
But hopefully understanding these concepts really empowers you, the listener, to make much better, more informed financial decisions, whether it's in your own life or in any business venture you undertake.
I think what's really fascinating here is that pretty much every financial decision you make, big or small, has some element of risk baked into it. The real power, I believe, comes not from trying to avoid risk entirely, because honestly, that's often impossible and can really limit your opportunities. But the power comes from understanding it, from measuring it where you can, and then consciously choosing how you want to manage it proactively. It's about being an active participant in your financial future rather than just, letting things happen to you.
That's a great way to put it. So the next time you hear about market volatility on the news or maybe currency fluctuations, take a moment, ask yourself, okay, how might this ripple through the economy? And maybe more importantly, what tools or strategies could I potentially use to protect my own financial well-being, or maybe even find an opportunity in it?
Yeah.
The knowledge we've uncovered today, hopefully, is like your secret weapon in a world that's definitely full of financial twists and turns.